permitting partnerships which previously did not use the tax basis, rather than going all the way back to the foundation and trying to recreate it, they may calculate beginning tax basis capital for 2020 using one of three methods. The modified outside basis, the modified previously taxed capital method, and the Section 704B method. You choose one of those methods to use for your beginning 2020 tax capital. You have to tell the IRS and your partners which of those shortcuts you used. That come in a little statement, a little additional information attached to the K-1s going to your partners and, of course, to the IRS. So everybody knows where we started. What is the modified outside basis method? Well, this is equal to my partner's adjusted tax basis in their partnership interest under the principles and provisions of subchapter K, blah, 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 and subtracting from that the partner's share of liabilities under 752 and the sum of their 743B adjustments. Now think, partner's outside basis includes what? Their proportionate share of the partnership liabilities. Remember when we form a partnership, you put in 10 grand cash, I put in 10 grand cash. In the good old days when banks would loan money, we would take our $20,000 down, go to the bank and borrow like $180,000 and buy a building, maybe an office building for the accounting firm, right? Sure. What would our basis be? His basis would be his 10 grand plus his half of the bank's 180. You get $90,000 of basis that he can personally use to take deductions and losses. Basis in other people's money. How cool is that? Kind of like you down with OPP? Well, you down with other people's money? Yeah, you get basis for nothing. Cool. So if our partners know their outside basis, then we can start with that, subtract their share of liabilities. Also, we might have to back off the 743B. Oh, what is that? What is that? Boy, if that's a quiz question, that needs more than an extra cookie at the afternoon break. That needs an adult beverage for somebody. Well, this refers to the partnership section 754 elections. But 754 is the code section for the election. And then basis is adjusted up or down due under what? Code section 734B and 743. 734 and 743. No, that ain't fair. They shouldn't have done that to dyslexic accountants. It makes it impossible to keep them straight. But the different adjustments are, one, when there's been, things going on in the partnership, like contributions of assets with built-in gain and built-in loss. The other one deals with outside things, like tax-free step-up in basis at the day of death and other adjustments. Well, if I have those adjustments on the outside, they're not really part of the inside capital account that we should be tracking. So we back those out as well. So, to do that, the IRS says you may rely in good faith and without verification on the adjusted tax basis information your client gives you, as long as it does not appear to be incorrect, inaccurate, or whatever, based on what's reasonably knowable to you. Okay? Excuse me. If you have not been maintaining tax basis for your partners, what the heck makes you think they've been doing that personally on the outside? You may rely on it. Yeah, good luck with that, people. No, this assumes your people can provide you with a reasonably accurate basis number to begin with. If you believe that is going to be common, brother, have I got a bridge to sell you. This may be an acceptable method. I do not think this is going to be a lifesaver for our profession. So we're looking at method number 2, the modified previously taxed capital method. Now this one is interesting, and this one might be doable. What do? We try to determine each partner's share of the inside tax basis of the partnership property, the partnership assets. And then we adjust things based on a deemed sale of all of the assets for their fair market value, pay off the liabilities, allocate the gain, and see what we got. In partnership law, you know how the IRS just loves that whole deemed sale thing? And conceptually it makes sense and it's easy and beautiful. Try and do it in reality. Good Lord, it's nuts. Determine the amount of cold hard cash each of your partners would receive if we liquidated the partnership after selling all of your assets in a fully taxable transaction for cash equal to the fair market value of the assets. Increased by the amount of tax loss determined without taking into account any 743 basis adjustments. Don't even begin to ask about those remedial allocations under the 704 regs. Oh gosh. There is not enough Tylenol in the building to get us through that conversation on a Friday afternoon, okay? Oh man, that's ugly stuff. Decreased by the amount of gain determined without taking that into account that would be allocated to your partner. IRS says, 734 do affect capital accounts because they're internal to the partnership and all its partners. I think I got to reflect this. That should be section 743 adjustments. The step up in basis for date of death or the cross purchase. It's only personal to that one particular partner. Now, this is interesting. And you can probably build a tax basis balance sheet for your partnership and look and figure out what our tax basis is in all of our assets and what we've got. And then we're, dealing with that when I'm on the cash basis. You're going to be dealing with unrealized receivables and payables and all of that stuff. Like I say, pass the Tylenol, but it's doable. You can build a tax basis balance sheet for your entity. I'll bet you can. Now try to get a decent, reasonably accurate number for the fair market value of each and every asset owned by that partnership as of or about January 1 of this year. Who's going to give you those numbers? How are you going to get them? How are you going to verify? How are you going to support it? For everything they got, tangible and intangible. Customer list, workforce in place, goodwill, trademark, everything. What's this thing really worth if we go to sell it? People who do that, routinely as part of what? Business valuations, right? What do they charge? Minimum what? 10, 15 grand? Now, I'm not trying to do a full business valuation, but a big chunk of it here, this deemed sale or liquidation. It sounds easy. Well, we'll just sell everything for fair market value. That's going to be fun. Instead of using fair market value, you can use their bases as determined under 704B, as determined for financial accounting purposes, or the basis set forth in the partnership agreement for use in case of liquidation. If it's in there, and if you can find it, and if you can figure out what the heck that is supposed to mean. But if you use one of those shortcuts, once again, you're going to have to disclose what method you chose to use and attach that to the K-1s going to your partners in the IRS. Method 3, start with your section 704B capital account. Now that is something that technically the IRS thinks you have been keeping and maintaining since its inception in order to be in compliance with section 704 of the code and the regulations. That is not a new requirement. That goes back to 704B and C added to the tax law about 1981, 1982. Old law, old religion, which we haven't been in compliance with for over a generation. Now, what makes a 704B capital account? Why is it different than tax? Because when we contribute assets, property to a partnership, it's reported for book financial purposes at its fair market value. You credit people's capital accounts and the assets on the balance sheet at fair market value. For tax basis, it gets reported booked at its tax basis. Both then on the assets that are over and in the tax basis of the capital account you get back and you go forward from there. 704B is a hybrid of book and tax. Contributed assets are valued at fair market value, and then things are adjusted, flowed through, posted based on tax stuff. So it's really a mixture, a crossbreed of book and tax. Only the IRS could come up with something that weird and that commingled. So you could start with that. Again, start there. Plus or minus your partner's share of section 704C, built-in gain or loss. I'm not going to circulate a quiz to figure out who can tell me that or what that is. Do you know what that is? When you form a partnership, maybe you and your dad going in 50-50. You're going to put in $20,000 of cold hard cash, $50,000. Your dad, who has been in the landscaping business previously, we're now forming a new partnership for you and dad, is going to contribute $20,000 of landscaping equipment, pickup trucks, trailers, mowers, weed eaters, blowers, and all that. $20,000 of appraised value, fair market value, solid as a rock. What is Dad's book capital account going to be? 20 grand, fair market value. What is his tax capital account going to be? Yeah, we're betting that it's all fully depreciated, expensed under 179, bonus. Dad has no basis whatsoever. He goes in at zero. And so you understand how book and tax capital starts out dramatically different from day one. And your and Dad's tax capital accounts will almost always be different. Also understand, at the liquidation of the partnership, the regs say liquidation may only be done in accordance with positive capital account balances. Since Dad's is lower than yours, he's not going to get as much out. We distribute things out 50-50, you will have violated code and regs. And then we can think about penalties for willful and intentional failure to follow the rules and regs, or the fact that if you violate 704, the IRS gets to reallocate income, deductions, loss, gain among the partners pretty much as they see fit. You know, that kind of stuff. So you kind of know that there. Do you also know that we are required to recognize and trace the $20,000 difference between Dad's basis and the fair market value of the assets he adds? That is Section 704C, built-in gain. Because the gain was there. Basis versus fair market value on the day Dad contributed it to the partnership. And we are required to trace that and track that. And if any of those assets are sold at a gain in any time in the next 7 years, is that gain going to be all depreciation recapture, ordinary income? I know how Dad thinks that's going to flow. 50 to you and 50 to him, right? Dad just dumped half of his depreciation recapture on you. Thanks for nothing, Dad. Are we going to let him do it? Are we going to let him get away with it? No, because we're accountants. And the tax law says we are required to trace that and to specially allocate any gain on the sale of those assets back to Dad and to shove it all down his K1. He's not allowed to dump half of that on you. This is not new tax law, people. And this is not like, well, my clients don't want a Cadillac return, they want a Ford. No, this is basic tax law. Unfortunately, we haven't done it. Why? Because we know if we do it, and we put all of that gain onto Dad's K1, he is going to be pissed, madder than hell at us. We're going to lose the client. So we don't do it. We forgot it. Accountants practice don't ask, don't tell long before the military caught on. Some of you in this room may actually, that description of 704C and built-in gain may actually be vaguely familiar to you. You may have recalled hearing about it somewhere. I hazard to guess that many of you have never actually seen that tracing and special allocation of gain in 7 years in practice in your entire professional career. Regardless of whether you have worked your entire time at a local firm, a regional, or a Final Four national firm. Because we haven't done it. Honest to God. IRS is picking up on that. They're coming after us. We'll see, I think, in a little bit where they've requested us the last couple of years, if there's a contribution with a built-in gain, you got to check the box and attach a schedule. They've added a box this year requiring us to report the Section 704C built-in gain or loss that has not been realized or captured yet. Mm-hmm. Yes, sir.
I think there's an interesting corollary with that, or a companion with that. Like if you trade in equipment, you used to be able to, 1031 into equipment. Now it's taxable.
Yes. Oh, great. He talks about the change in 1031. I love this one. Why? Your client had a used delivery truck that is worth $40,000. You can look it on kbb.com, right? No doubt about it. They could put a sign in the window, park it on the corner of any, busy intersection here in Nampa or Boise, and sell it in a couple weeks for $40,000. Why? Why is his client stupid enough to take a $36,000 trade-in allowance from the dealer? Why do they let themselves get used like that? They stupid? No. If they would sell the truck for $40,000, his client would have had $40,000 of Section 1245, ordinary income depreciation recapture, which is going to cost them about how much in additional taxes on that return? You know, what were they, 25, 30% rate? You do the math. Probably cost them $12,000, $15,000 in taxes. They weren't stupid taking the trade-in allowance for $36,000 from the dealer. They were really smart. They were coming out about $8,000 ahead, weren't they? Sure were. Not anymore. TCJA does what? No more 1031 like-kind exchange on anything but real estate. See, that's what we got it through when we traded it in at the dealer. That was a like-kind exchange. No income, no depreciation recapture, no gain. Now, for a lot of tax purposes now, it doesn't matter. So what? We traded in, I got $36,000 in ordinary income depreciation recapture. Oh, so what? Hurt me. Why? Because now that $36,000 trade-in allowance is part of my purchase price, my cost or basis. I take 100% bonus. Boom, it's a wash. No harm, no foul. Other than the fact that now, when Dad decides a couple of years from now that we want to sell or trade in that pickup truck, we get an $8,000 or $12,000 sales price or trade-in allowance. It's supposed to hit them. When we have this, you should have a carry-forward work paper. Do you remember those? Do you remember what they looked like? We used to do them, right? We had file folders. And on the one side would be clip things like the trial balance, adjusting entries, financial statements, and tax returns. And clipped on this side were all the work papers and support documents. And sometimes he would think of something that might be important down the line, and so he would write on it, carry forward, usually with a red pen or pencil, right? And every year in the fall, the admin staff would make up the new file folders for the new year. And one of the jobs that we would assign the young accountants is to go through and look at all the work papers. Find the ones that said carry forward. Make a copy. Put the copy in last year's file. Move the original to the new file. What do we do now that we've gone green? Paperless. Efficient. At the end of the engagement, all of the work papers, everything is scanned into the computer, and the originals are shredded. We've got to reduce our carbon footprint. They're put in there. They're safe. Saved, preserved, secure for all time. They have secure storage in our system on our computer servers. We have secure off-site backup, tape, disk, or through the cloud. And of course, there is the triple secret third copy that is made of all of your files that the NSA sucks up out of your computer system. You know they have it. They have everything. Why did we ask the Russians for a copy of Hillary's server? They have it. It's all there, safe and secure. And those carry forwards are in the middle of a 247-page PDF. Is anybody ever go through, look at all of those, pick out the ones that say carry forward, make a copy, move it to next year, or move it in the perm file, or roll it over into the different folder? No! It's there, safe and secure. But like whatever they sealed into the time capsule in the cornerstone of City Hall, no living person will ever see it again. We have lost the art of the carry forward work paper. We really need to figure out how to recapture, rediscover that art. And the IRS is starting to call us to account on more and more of those. Think about that this weekend. All right. 704C at the contribution, fair market value, different from adjusted basis. plus or minus gives a 704C built-in gain or loss, which has to be traced to that particular partner. Now, one observation that came up, I taught the class virtually remotely 2 weeks ago that Bruce brought up. I believe he was out of Nebraska. He said they do a fair number of fairly large partnerships, and he says, for original partners who invested pro rata with cash in original equity interests, their inside basis of the partnership and its assets, inside tax basis, should be pretty dang close to what people's outside basis was, with the exception of maybe 704s, or 754 step up in basis at death, or a couple cross purchases or whatever. Your biggest challenge will be people who acquired their partnership interests later. Now, the IRS has announced that they intend to give you penalty relief for 2020 as long as you exercise ordinary and prudent business care in following one of their methods to calculate and report beginning tax basis capital accounts. So if we can get through this ordinary and prudent business, thing, then this issue is done and we just roll forward from here and call it good enough. But ordinary and prudent does not just take whatever we had, just call it tax basis and move forward, knowing that it was book or financial statement before and now we're just going to call it tax. I don't think that kind of cop-out or shortcut gets you that kind of penalty relief. And then the question comes, the IRS had required beginning in 2018 for us to report negative tax basis capital account information for partners who had a negative tax basis capital on line 20, other information of the K1 coded AH. And they extended that once from 18 to 19, and then, do you think they'll postpone this, delay it, maybe even drop it? Well, that whole optimist-pessimist thing? You got to understand who Doug is. The glass is always at least 3/4 empty. Don't believe what your lying eyes are trying to tell you. Okay, that's who I just got to understand where I'm at. I don't think they're going to. No. Remember 2019 when they came out with the draft form. They were requiring tax basis capital for everybody on 19. And we screamed, we howled, we said, no, we can never get this done in time. Are you nuts? And they gave us a year. They delayed it. They've already given you a 1-year extension. I don't know if they're going to give you another now. And remember, 2019 could have been fine. Economy was good. Businesses were profitable. Lots of taxable income coming through. It wasn't much of a big deal. Now with the pandemic, now with the kind of tax losses we're afraid we're going to be seeing and processing this year, your clients, the partners, and the IRS need reasonably accurate and complete basis in order to determine the deductibility of their losses. They need that information now more than any of us have needed it any time in the last 10 years. This is no time for the IRS to drop the ball. I think they need to stick to it. I think they will. And then here, you see that little box there? Did the partner contribute property with a built-in gain or loss? Yes or no? And the question is not ever. The question was this year. And so if you did, on your K1, for you and Dad forming a partnership, you put in cash, well, the answer is no. For your dad, you check the box yes, and you need to attach a statement, a piece of paper, a schedule, describing each asset your dad contributed to the partnership, the date of it, and the amount of its built-in gain or loss, the difference between its tax basis and fair market value, the beginning point of your carry-forward work paper. And then we're supposed to watch and follow those assets through the next 7 years. And when they're sold or disposed of, if there's, we got to specially allocate back to Dad. Now, most people never check the box, even when they were supposed to have. Never attached a statement or schedule. Never had anything to carry forward. Never looked for anything again. Now the IRS has gone on beyond that and added this new little thing here. What is Dad's share of net unrecognized 704C gain or loss at the beginning and ending of the year? I think they're going to be looking for it, don't you? Time for us to get with the program. Okay. How about S corps? Did they have any issues?
We only have to do that for the 7 years?
Yeah. Because that's when the 704C, the required special allocation, expires. Now understand, if we, to protect Dad, don't sell any of that crap for 7 years. It's easier to do in real estate than it is in operating business. But we just don't. Then Dad never has to worry about that special allocation coming back. But understand, tax basis capital, Dad's will always be lower than yours is. Someday, when we have time, and either Tylenol or adult beverages at hand, we should also talk about Section 704B and how the regs require us to reallocate tax depreciation away from Dad and to you in order to make him to start record. Like I said, that needs a lot more.
We love that stuff.
If you want to geek out, it's great, but man, you may need some Tylenol or adult beverages to get through that conversation. Yeah. And so I think the IRS revisiting and resurrecting that law from the early 80s may also be part of this program. See, I vaguely remember this because I was in law school when that hit the fan. And I had a partnership tax class, was an elective, that spent dang near the entire semester on the 704Bs and C regs. It's that hairy, it's that ugly, and you know. Yeah, here it comes. Whoa. All right, S corporations. S corporations are different than partnerships. Because partners, both of them, you get basis equal to the tax basis of what you put in. But partnerships get that basis in other people's money in your share of the liabilities and debts of the partnership. S corps don't. You only get basis for what you put in, and for your stock, and for debt, but not debt of the S corp. Only for money that you personally directly loan bona fide to the S corp. That is the basis you get to have in order to deduct your losses. I love this. It's getting a little older dated, But this is from the AICPA Tax Section Weekly email newsletter, going back to, 2011. And apparently they have a group that gets together sometimes called the S Corporation Taxation Technical Resource Panel. Doesn't that sound like people you want to go out with on Friday afternoon? I don't think so. But they were having a meeting, and they had a special guest, an Irs Field Specialist. What is a field specialist? Is that like your auditor or your auditor's supervisor? Is it IRS collections, the ones that look like Vito and the others, extras on The Sopranos? No. It's not even a super auditor. Field specialists are IRS go-tos. I'll bet you have go-tos, go-to gals and go-to guys at Ripley, don't you? You know that if you have a question about a 1031 like-kind exchange, you go to see him. If you have a question about inventory rules, book and tax, you go see one of those guys. If you got right, you know your go-tos. This is an IRS go-to. When your field auditor and their supervisor have questions, have issues, technical, and they don't know what the answer is, this is one of the people they go to. So she made a guest appearance. Said the top 3 problems, the top 3 issues the IRS was having in S-Corp shareholder audits were basis, and basis. Yes, a clean sweep of the top 3. It's all basis. She indicated that shareholders are not proper. She is too kind.
Yeah.
Shareholders don't do this. She meant the accountants. She was being polite. Accountants were not properly tracking or computing components or basis, particularly when shareholder loans are taken into account and when those loans are repaid. Yeah, that was fine. But forgive me, what did they do about it? 12, 13, 14, 16, 17, nothing! Well, quit whining to me. Okay. Oh, but did you know that 3 years ago, the AICPA sent a comment letter to the IRS recommending that they require mandate basis reporting? What? I thought they were on our side. That's supposed to be our union. What are they doing with that? What was interesting is they recommended, they didn't want it to be required or put on the burden of the S-Corp. They pointed out that S-Corp shareholder basis is a personal individual tax attribute. And that often the S-Corp will not have access to or even be able to require all of the information you need for a basis schedule. If you have a partner in a partnership and one of your relatives dies and you receive that partnership interest with a tax-free step-up, are you required to tell the partnership about that, how we valued it, and what the step is? No. They probably can't make you tell either, but you're gonna. Why? Because we got a 754 election in place, and we're gonna process that and reflect your stepped-up outside basis inside and specially allocate extra depreciation to you, aren't we? So of course he's gonna tell the partnership about it. How about an S-Corp? They don't do 754. Not allowed. It's not an option. So whether there's a death in a tax-free step-up in basis or a cross-purchase, are you required to tell the S-Corp about that? Well, that it happened, transferred, but how much? What the value? What was paid? No. That was one of those things my dad always said are none of your dang business. So he's really not, you can't really require this of the S-Corp. Although in general that is the place that makes the most sense to maintain. AICPA recommended that be required reporting on the 1040. Thanks, guys. Thanks. So look at this. See this on the form? You know, we're accountants. And one of the challenges we have is we don't read the forms. We don't look at the forms anymore or the instructions. We look at the software and the inputs and the reports. And to the extent we look at the final form, we look at the 1040, page 1 and 2, and sometimes Schedule A. And that's about it. So when the IRS adds something like this to the forms, a lot of us never even see it. And we didn't. This is not new for 2020. The IRS added this to Schedule E, top of page 2, beginning in 2018. So what's it say? If you report a loss, receive a distribution, dispose of stock, or receive a loan repayment from an S Corp, you must check a box in column E and attach the required basis computation. Oh. 18, 19, and here again. Now, a lot of accountants blew that off. A, we didn't miss it, or we said, well, it didn't apply. Well, maybe it didn't. Remember 2018 and 19, things were good. We were profitable. So, no, we didn't report a loss. We didn't dispose of stock. Didn't get a loan repayment from an S Corp. Okay, nothing to report. Move on. Notice how I just managed to kind of skip over that whole thing about receiving a distribution?
Yeah.
But if we were profitable, if we were generating taxable income on the K-1, our shareholders were screaming for distributions from the S Corp to give them the cash to help pay the taxes on that K-1 income. Of course there were distributions. I have to believe that at least 90% of all partnerships had one of those things happen. Either they had a loss or they were profitable and they were making cash distributions in 18 or 19. And basis reporting was required. Here we are again in 2020, and either we're lucky enough to, well, we probably had profits in 2019 that we distributed cash to help them pay the taxes on the K-1 income. And then it all turned to COVID. It's required. Oh, crud. IRS has worksheets in the instructions. Help you calculate the basis of your S Corp stock, as well as the loans you make to the corporation. Yep, they're the IRS, and they're here to help you. Particularly on the stock basis one, your software will do that for you. It really will. If and only if you give it a beginning balance number at the start of the year. If you never tell them what your beginning basis is, it's never going to calculate this, and it will never send you a diagnostic or a nastygram that you don't have it. Because you didn't give it what it needed. Software does great things with it and all of that. Now, the IRS granted partnerships that failed to report negative tax basis capital account balances in 18 penalty relief. They said, if you failed to do it, we won't spank you. You got to send a schedule of basis in. But they said failure to report Negative tax basis capital on Schedule K1, line 20, code AH, was subject to penalty under 2 code sections. And the one was, it was a 7,000 one. I forget the number on my feet here. Failure, where you get penalized for failing to send complete and accurate information returns. Failure to file K1s. Complete and accurate. They said it was also subject to penalty under section 6698. The penalty for failure to file a complete and accurate return. Now, I don't really care or worry much about the cash penalty under 6698. Do you? What I don't like about failure to file a complete and accurate return is the question about, if I get hit with that penalty, have I actually started the running of the statute of limitations, or did the statute not start? Because I didn't file a complete and accurate return, which means it doesn't close after 3 years. The IRS can go back more. Well, if I was required to do this and I didn't, do I have a 6698 problem on the 1040 of my S Corp shareholder? Yikes! Yeah, I hate that stuff too. IRS to this point has offered up no comparable penalty relief for S Corp shareholders failing to do that on the 1040. So here we are again, 2020, losses coming through, critically important information. I think we got to look, if I was your, perish the thought, tax peer reviewer, coming in to do your tax peer review next week Tuesday, and we pull a representative sample of the 1040s where they own S Corp stock. And what percentage are we going to find reasonably complete and accurate S Corp basis schedules right now? Sorry. I'm not a nice person. But you got to understand, one of my goals whenever I teach a class is that everybody has about 3 oh crap moments. Yeah. All right. Well, in the time I have left to me, let's talk about something happier. Meal and entertainment expenses, except it's not so happy anymore. After 30 years of whining and complaining about the 3 martini lunch, they finally did it this time. Wait a minute. How did they do it? Man, I should have judged, but you probably knew some of them when you were a young accountant. How did the old school guys ever do the classic 3 martini lunch? Come back to the office and do anything but close the door and take a nap on their desk in the afternoon. I'll never know, man. Better men than I'll ever be. Yikes. Well, now, no more. The Act completely eliminates nearly all entertainment expenses. No more golf. No more concerts, Garth Brooks or Beyonce. No more symphony. No more theater. No more fishing trips. Whoever would have thought the Republicans, the party of fat cats and rich guys, would have done this to us? Come on! Man, oh man! Why? They needed the money. They had a total budget target they were coming in on, and last minute they ran short. This is $4 billion a year of taxes over a decade. And that is $4 billion to be paid by your business, your client, your CPA firm, and others. This means us. Code section 274 used to be the one that said, since about 86, There is no deduction for any item with respect to a facility used for entertainment. Facility costs are money you pay to give you access to an entertainment venue. And so that's why you couldn't deduct your dues to belong to the golf club or the tennis and racquetball club or any of that kind of stuff. But you could deduct activity costs, including, 8 greens fees for 18 holes and cart rental and all the rest of that. Now activity is disallowed as well. Any activity generally considered to constitute entertainment, amusement, or recreation. Basically, fun. The IRS hates tax-deductible fun. Now, what is entertainment? The fact that you don't think it's fun is irrelevant. Okay? He says, somebody's got to take one of our clients out, suck up to him a little bit. And he says, oh God, no, please don't make me go to the monster truck thing down at the arena. And he says, I'll go to the monster truck thing, but don't make me go see Garth Brooks in concert. And he says, I'll go see Garth Brooks, but don't send me to the symphony. Okay? The fact that you think it's awful and no fun doesn't matter. Have you been noodling? Do you know what noodling is? It's a form of fishing, right? They don't use a rod and a reel or a net. They take their shirt off and get into the mucky, swampy water. And they take their bare arm and they stick it under the river bank or the fallen log, waiting for the big honking catfish to chomp on. Yes, you use your own arm as bait. And the thing chomps on and they wrestle it up on the river bank and throw it there. This does not look like fun to Doug. But when I see it on YouTube, they seem to be having one heck of a good time. There appears to be a lot of beer involved, people, a lot of beer. The fact that you don't think something is fun or entertaining, if other people do it and smile and put YouTube videos up, I think it's entertainment, okay? The fact that you call it, no, it's promotion, it's business development, it's marketing, garbage. It's entertainment. And it's now non-deductible. Zip, zero, none. Well, question came up in that previous IRS guidance, going back to 1963, indicated that entertainment included satisfying people's personal needs, including like dinner, food, and drink. No, that's not entertainment, really. You guys thinking or planning, at least until we hit, phase 2 tonight at midnight? Going out for dinner with a spouse or significant other? Do you guys consider that entertainment? Date night? Oh, Iris has got a point there. They really do. But Congress didn't really mention business meals. So in Notice 2018-76, the IRS said the legislative history of the Act clarifies the position that you can deduct 50% of food and beverage costs associated with operating your business. They didn't say where in the legislative history. I'm not sure I can find it, but I'm glad they did. And so you can continue to deduct half of an otherwise allowable business meal if it's ordinary and necessary, paid or incurred in carrying on your trade or business. It's not lavish or extravagant. You have one of your people present because somebody has to be physically present to talk business, products, services, contracts, opportunities. If nobody's there to talk business, it's not a business meal. It's a gift. You sent them out for lunch or dinner by themselves and you're picking up the tab. That's not a business meal. It's a gift. And gifts are deductible up to what? $25 per year per recipient, which I think means a single Olive Garden gift certificate, and you're capped out, right? Pretty much. And then things had to be furnished to a current or potential business customer, client, consultant, or the like. Now that was helpful, except that list leaves off things like employees and partners. So we had a problem with employee business meals still. You know, it's time for his annual performance review. You could do that in the office, but you know what's going to happen. Everybody's going to be looking, peeking, watching, because we all want to see if he cries again like he did last year. Or a couple of the partners need to have a conversation about some really important things about the business and the firm and new clients and all of that. Can they have that conversation in your offices? Not a chance. The moment they start to. Just a quick question. A couple moments later, it's like, can I please bother you? Oh, the phone rings. One of them gets paged. They can't get 3 sentences out of their mouth without an interruption. The only way for them to do so is to go off-site, maybe at lunch, and have a conversation about very important firm business. But none of these fall within that definition in the notice. IRS then said also, if we're at an entertainment activity, food or beverages purchased separately, or the cost of which is separately stated, are still 50% deductible. So your tickets to go see the baseball or football game are now non-deductible. But hot dogs and munchies and drinks and all of that at the ballpark, 50%. Okay. IRS announced they intended to publish regs. Believe it or not, they were as good as they were. They proposed those regs in February. And then, 6 months later, stepped up and finalized them the end of September. We now have final regs on meals and entertainment, guys. They added 2 sections. Section 11 for entertainment, and Section 12 for food and beverages. IRS made it abundantly clear from one end to the other, methinks they don't protest too much, but that 50% for food and beverages generally remains in full force and effect. Entertainment, non-deductible. But then, in accordance with Notice 2018-76, the IRS kicked off what promises to be a long and ugly struggle over mixed expenses. Entertainment, non-deductible. But food or beverages that are purchased separately, or the cost of which is separately stated, is deductible. So, in the past, maybe we would have taken one of our clients to a charity golf outing here in town. Tickets are $80 each. And for $80, you get 18 holes of golf, a cart, there's drinks, a drink cart while you're golfing, and then at the end there's the dinner and auction and stuff like that. $80. The IRS says here what you can do is maybe we say of that $80 ticket, maybe we sell it separately. $40 to get in the golf and the cart rental and all that, and $40 gets you the wristband, which gives you your free drinks and dinner and munchies and all of that. Purchase separately. Or we can separately state the price. That $80, $40 is golf, and $40 is for your food and drinks during the day. Great. So, of course, one of these smart alecks says, okay, well, what if we say that golf is like $5 or $10 and 75 is for food or drinks? Then only $5 is non-deductible and we'll get 50% on everything else. No, the IRS saw that one coming when they got to the final regs. The amount charged for food or beverages must reflect the venue's usual selling cost. Hey, at the ballpark for baseball games and football, I know that stuff is grossly overpriced. It's very expensive, right? But that's what they sell it for because they kind of got a monopoly at the ballpark. Okay? Or, and that would be the case for the golf outing. How much is for golf? What is the normal price there at the golf club for 18 holes and a cart and stuff versus food and drinks? Or it's got to approximate the reasonable value. If we purchase a bundled activity and there is not a separately stated or separately purchased amount, no allocation is made, and the entire $80 is non-deductible. No, you may not do the accountant's rule of thumb on the back of a napkin or whatever saying how much you think is deductible. If it ain't broken out, it ain't sticker price, it ain't a la carte menu or whatever, you may not allocate between deductible and non-deductible. Sorry. So, you buy a ticket to the ball game? Cool. Hot dogs and drinks? 50% deductible. When you purchase tickets to the luxury box or suite at the ballpark or the arena, which, gets you admission, and you got nice seats and you can see the stage or the football field or whatever. And it has not only food and drinks brought in there for everybody, but the best part of the luxury box, and I've done this twice, is that there's a bathroom in there. And so you don't have to wait in the long line down the hall and all that. You can just do that. Oh, it's wonderful. Especially if you're bringing spouses and kids with, trust me. If it's just, this is what it is for a seat or box in the suite or whatever, that's it, and no allocation. The entire amount paid is non-deductible. So let's come back to that earlier thing about business meals with staff or employees. His annual performance review, the partners having that really serious meeting. 2018-76 said customers, clients, consultants, act alike. It really didn't help us out with staff or employees. Well, in the regs, the IRS expanded the definition to allow us to deduct 50% of business meals with what is called business associates. Persons to whom you could reasonably expect to engage or deal in the active conduct of your trade or business. And that means somewhere in the reasonably short to near-term future. Okay? This is meant for one of the audit senior managers when I was a baby accountant at Ernst & Winnie, who was famous for saying, I never go on dates. I only have dinner with prospective clients. Forgive me, Yahoo. The off chance, long shot deal that someday one of your exes might actually ask us to prepare a 1040 does not make this business development. Call bull. Same thing here. It's got to be somebody we could reasonably expect your business to be doing business with in the not too distant future. And then in addition to customer, client, supplier, agent, and the like, you see what the IRS added: employees, partners, and professional advisors, whether established or prospective. So now, can we, instead of doing his performance review in the office where everybody wants to see what's going on, can we take him out to lunch? Get off-site, away from all those prying eyes? Maybe even soften his pain with the beverage of choice? Yes! Can the partners go off-site to have that very? Yes. Can we take, we're hiring a new accountant. As part of the interview process, we are going to take them out to lunch and see if they can actually walk, talk, and chew gum at the same time without making a fool of themselves in public, right? Yeah, all of that's good now. New definition, business associate. Also says, hey, when I got clients, prospects, and the like, I can do it in a combined event. So you take a client out to lunch, an employee to discuss a performance review, 50% deductible. No deduction allowed for food or beverages provided to spouses, dependents, or significant others accompanying the taxpayer on business travel, unless they are a bona fide employee of the business. They are there for a bona fide reason. In fact, if your client, if the taxpayer had to cancel for some reason, could the employee, spouse, child, or significant other, would it be appropriate for them to go on this travel, on that, meet with people, do that in their own right? If yes, their meals and all traveling are deductible. If not, they may stow away in your suitcase. They may use and enjoy your hotel room in Las Vegas or Hawaii or whatever. You can use your frequent flyer miles accumulated on business to get their free ticket to take them with you to Vegas or Hawaii. But you can't deduct any of their meals and stuff. Now, food or beverages means the total cost. Apparently, between the proposed regs and the final regs, the IRS thought, they started hearing stories about people who, 50% of food cost is non-deductible. So when we order pizza for lunch at the firm on Wednesday, the pizza cost is only, but sales tax and the delivery charge and the tip we give to the pizza guy who's delivering, that's not food cost, so we'll deduct 100% of that. IRS calls bull on that. Okay? It's the full cost, including delivery fees, tip to Uber Eats or whatever, tips, sales tax, all of that. Now, when you're feeding people on site, we don't have to include expenses for operation of the eating facility, its overhead, and all of that. So, company, cafeteria, and all the staff, nope. And then the bad news, because I got to end this now, and probably with an unhappy thought for you guys to take home with you. IRS stuck it to us here, all of us, even the accountants. Joe Kristen is a CPA, I believe, with, Bailey in Des Moines. He's fairly active on what's sometimes called tax Twitter. He talks a lot. Bright guy, very nice. Said that break room snacks might have been the hardest thing hit in the proposed regs, and again in the final. Well, what does he mean? The IRS says food or beverages, of which 50% is non-deductible, is all food and beverage items, regardless of whether you call it meals, snacks, or something else. And regardless of whether it is being provided or treated as a tax-free de minimis fringe benefit. You know, when we have, good news, people. We're ordering Subway for lunch on Monday. Get your order in. And he says, I would like a turkey club. You want a spicy Italian? You want a meatball? Okay, good. We're having a committee meeting at noon. Meet me in the conference room. Have I really splurged and treated them for lunch on Monday? No! I stole their lunch hour. I stole their break. when they could go for a walk, go out to lunch, decompress, shop on Amazon. I stole their lunch break and I did it with a 6-inch sub. Don't you people feel used? Is that taxable compensation to our friends here? No. That's a de minimis fringe benefit, no big deal. It's, it's too small to keep track of individually. That's tax-free. That does not make that stuff 100% deductible. Oh, crap. And so now all break room snacks, I don't know what kind of a smorgasbord you guys have with bottled water and pop and munchies and Skittles and all of the rest. I mean, in a lot of firms, particularly during busy season, man, I mean, that is a, junk food and grazing orgy, isn't it, man? Why? Because we got to keep people fed and watered and their energy level up, right? This is ordinary and necessary business expense. Yeah. It's 50% deductible now through 2025. And then in 2026, as the tax law stands, all of those, provided to the employee stuff becomes 100% non-deductible under the tax law. Zip. And so some people have tried to argue, apparently, that no, the break room or the lunchroom is actually a recreational or social facility for the benefit of employees generally. Therefore, 100% deductible, code section 274E4. Kind of like the holiday party and the summer softball game and hot dog festival and all that. IRS says no. The fact that your people might yap or chat or socialize a little bit in the lunchroom or break room does not make it a recreational facility. So they give us an example number 3 in the final regs and drive a wooden stake through the accountant's heart. An employer, Ripley, provides free soda or pop, depending on what part of the country we're in, bottled water, chips, donuts, and the other in a break room available to all employees. You may only deduct 50% of the cost. Look at what they did. Coffee, people, the lifeblood of accountants. Yes, that is only 50% deductible now through 2025, and after that, nothing, honey. Oh, they know how to hurt an accountant, don't they?
What if the IRS ought to read some copy?
He'll enjoy it, knowing that it's not deductible to your client. Now, I know our clients are going to say bullshit and all kinds of stuff like that, right? And they're going to bury it in office supplies and miscellaneous expense and all of that. And, okay. And, accountants did don't ask, don't tell long before, right? Okay. But you do know that the IRS has bought thousands of copies of QuickBooks and trained agents how to use it. And it's a fairly routine information document request. Usually comes at the close of day 1 for a copy of the complete QuickBooks backup file on disk. So they can go back to the office and either themselves or one of their go-tos down the hall just kind of skim through all the detail in some of those usual hiding places. I'll play don't tell and all that, but when the audit comes up and they get burned, they thought they were hiding something, don't come crying to me, Argentina. That wasn't my fault. Shouldn't be yours either. Okay? I gotta shut up. Couple quick things though. When more than 50% of the people in attendance are the general public, not your staff and employees, then it's 100% deductible. So if you got a real estate agent holding open houses and, they have bottled water and drinks and stuff there, and they always bake cookies in the oven, because fresh cookies give that good smell, for the open house and all that. It's consumed by employees, potential buyers, and other agents. As long as over half of the people eating are outside, then it's 100% deductible. Same thing, the auto service center. They got, coffee and munchies and all that in the waiting room. Their employees always also go through as well. If more than half is generally consumed by the guests, the customers in the waiting room, we're 100% deductible. If over half is usually consumed by our staff and employees, then we're looking at 50%. Okay, last thing. Restaurant or catering service can deduct 100% of the cost of food and beverage items in connection with preparing and providing meals to its paying customers, including those consumed at the work site by the employees. My daughter used to work at Big B Coffee, which is, like the Seattle's best, or, Starbucks or whatever. And you get shift premium. For every so many hours you work, you get a free coffee. You get that at, working at Burger King, McDonald's, all kinds of places, right? Yeah. How do we treat that? IRS says if it's, done on site and part of, this is part of what we're doing, then my meals, including my employees, getting their shift premiums and others, is still 100% deductible. Catering company goes out, doing weddings and bar mitzvahs and stuff, and you got to feed them and water them out there, you're good. So, up till now, most of your clients have had one account in the general ledger. Meals and entertainment, parentheses, 50%, close parentheses. I don't think that cuts it anymore. I think now they need 4, maybe more accounts. Number 1, entertainment, and you might as well just face it, 0%. And your tickets, your golf, your whatever, just bite the bullet, reasonable, good faith effort to comply, just do it. Business meals, 50%. And that's going to be meals with customers, clients, employees, all of that. Do it. Travel meals, when you are in travel status, are also 50%. But I like to see that separated. Because once you establish that she is in travel status, away from home, on business, overnight, my documentation, requirements go way down. It's easy. I don't have to prove who she's with, what she's talking, no, I'm done. And so I like to segregate that from the business meals where there's more exposure and more documentation and more potential to get sucked into trouble. And finally, it's not a very good title. I'm looking for somebody to give me something that's a little catchier or sexier, but I'm calling it employee on premises. And that's bringing in donuts, in the morning, Subway lunch for our committee meeting, pizza lunch on Wednesday, break room snacks and coffee, and all the rest of it. Face it, 50% now going to nut and honey in 2026. All right. And I don't have time for that. So, thank you guys. I can't believe this has been so much fun for me. Would you believe this is the first time I have been live and in person in front of accountants since January, by golly. The web thing, the virtual, man, you lock yourself in a room and listen to yourself all alone for hours is awful. Even though I couldn't actually see all of you smiling all the time with the mask, I could still see a lot of grins and smiles going on, and this has been an absolute treat for me. So thank you guys. You've played along really well. Good luck in the coming busy season. It won't be a good one. I hope it'll be better than the last one, all right? Enjoy your last evening of freedom here in Boise, guys.